What's up, my people? And I'm back with another Attila advising video. And in this video, I'm going to quickly explain what is a bond and how it can be used by companies and governments to raise money, and how you may benefit by adding bonds to your investment portfolio. A bond is essentially a loan given to a government or company by individual investors like us. When a company issues a bond, it is promising to pay back the investor that money plus the interest during the duration of that bond. For example, if bond yields for a 10-year bond or a maturity, which is the duration of the bond, is 2.8% or whatever it is right now. So if a government wants to fund a war as they did in World War I, they will issue bonds hoping that citizens feel it is safe to invest in that government and use their cash to buy these bonds at face value. Then the government will use that cash to buy ammo, pay soldiers, or whatever expenses needed to maintain this war. The government then promised to pay investors that 2.8% yearly until the 10 years are up and the bond reaches maturity. Then the government promised to pay back the full price of the initial investment. Most economists and investors see this as a great low-risk investment because you are essentially lending your money to a government, which seems like a risk-free investment. But no, there is no such thing as a risk-free investment. Bonds are a great way for investors to retain the value of their money and beat the rate of inflation. True, it offers a fixed rate percentage and passive income during the duration while you own this bond. There are many different kinds of bonds. Some issued by municipalities, some issued by corporations, and other by the U.S. government. Municipal bonds, corporate bonds, and U.S. Treasury bonds. Bonds are held by many governments and Fortune 500 companies all around the world. Bond yields, though safer, do not amount to the returns of the stock market because you are considerably taking less risk when you buy a bond rather than a stock. What's also good to know about bonds is that if a company or corporation goes bankrupt, the bondholders are paid out before stock shareholders and stockholders after liquidation. Bonds aren't a great substitute for the other inflation hedges that I mentioned in my other video, but it can be a great substitution to the APY given by a savings account or just holding cash. I am not a financial advisor, and this is not a financial advice. This is just another Attila advising video where we have everything you need, like a corner store. Like, subscribe, and I'll see y'all in my next video.